Invoice factoring is one of the most misunderstood financing tools in business because many owners assume it is just another loan. In reality, invoice factoring has nothing to do with borrowing money. Instead of asking a bank for cash, a business simply sells its unpaid invoices to a factoring company in exchange for immediate working capital. To understand why this matters, imagine a wholesale food distributor that supplies products to supermarkets across several states. During the month, the company delivers goods worth $100,000. The supermarkets accept the delivery but agree to pay within 60 days, which is very common in business-to-business transactions. On paper, the business looks successful because it has generated $100,000 in sales. However, the bank account tells a completely different story. Employee salaries totaling $20,000 are due next week. Suppliers expect payment of $35,000 within 10 days. Fuel costs for delivery trucks add another $8,000. Warehouse rent is $5,000. Insurance and utilities total $3,000. And several software subscriptions and operating expenses require another $4,000. Although the business has earned revenue, it does not actually have the cash needed to operate. This is the difference between profit and cash flow. Revenue has been recorded, but cash has not yet arrived. Instead of waiting 2 full months for customers to pay, the business sends the unpaid invoices to a factoring company. The factoring company verifies that the invoices are legitimate and confirms that the customers have agreed to pay according to the original payment terms. Once verified, the factor agrees to purchase those invoices. Suppose the factoring company offers an advance rate of 90%. On an invoice worth $100,000, the business receives $90,000 within 1 or 2 business days. Suddenly, the cash flow problem disappears. The company immediately pays employee wages, purchases fresh inventory, covers rent, pays transportation costs, and continues serving customers without interruption. The customers still pay according to the original agreement, but instead of sending payment to the supplier, they now send it directly to the factoring company. After receiving the full payment, the factoring company deducts its agreed fee and returns the remaining balance to the business. Imagine the total factoring fee equals $3,000. The factor had already advanced $90,000. After collecting the full $100,000 from the customer, the factor keeps the $3,000 fee and sends the remaining $7,000 back to the business. In total, the business receives $97,000 while gaining access to most of its money nearly 2 months earlier. Notice what actually happened. The business did not create new debt. It did not make monthly loan payments. It did not pledge equipment or property as collateral. It simply converted an unpaid invoice into immediate cash. Now compare this with a company that decides not to use invoice factoring. That business has only $10,000 left in its bank account while waiting 60 days for customer payments. Because cash is tight, it delays purchasing inventory. A large customer places another order worth $50,000, but the business cannot fulfill it because there is not enough money to buy raw materials. The owner is forced to reject the opportunity, not because demand is low, but because cash flow has become the biggest obstacle to growth. The company may even delay payroll, miss supplier discounts, or pay late fees on essential bills, all while sitting on a large stack of unpaid invoices. This example shows why experienced business owners pay close attention to accounts receivable instead of focusing only on sales. Sales do not keep a business running, cash does. Invoice factoring allows businesses to unlock money that is already earned but temporarily trapped inside unpaid invoices. It transforms future payments into usable cash today, allowing operations to continue smoothly without waiting for slow-paying customers. For businesses that regularly sell to reliable commercial clients with payment terms of 30, 45, or 60 days, Invoice factoring can turn a growing list of unpaid invoices into a steady source of working capital, making it easier to operate, grow, and confidently accept larger customer orders. How factoring improves cash flow. The biggest advantage of invoice factoring is not simply getting paid earlier. The real advantage is maintaining healthy cash flow so the business never has to slow down because customers are taking too long to pay. Consider a manufacturing company that produces custom metal parts for commercial construction firms. Every month, the company ships products worth $200,000. The construction companies are financially strong, but they pay invoices in 60 days. Meanwhile, the manufacturer cannot pause its operations for 2 months. Every week, it must purchase raw materials, pay machine operators, cover electricity costs, maintain equipment, and pay shipping companies. If the business waits for every customer payment before spending money again, production will eventually stop. Instead, the owner decides to factor the invoices. The factoring company advances 90% of the invoice value, giving the business $180,000 within a couple of business days. Rather than sitting on unpaid invoices, the owner immediately has enough working capital to keep production moving without interruption. Now look at how this changes day-to-day business decisions. The owner receives a bulk purchase offer from a steel supplier. By paying immediately, the supplier offers a 10% discount on materials worth $50,000. Without available cash, the business would have missed this opportunity and paid the full amount later. Because invoice factoring provided immediate cash, the company accepts the discount and saves $5,000 on a single purchase. That saving alone reduces the overall cost of factoring. A few days later, an important customer places an urgent order worth $75,000. Since cash is already available to purchase additional materials and schedule overtime for employees, the company accepts the order instead of turning it away. Faster access to cash allows the business to generate even more revenue instead of losing growth opportunities. Invoice factoring also improves relationships with suppliers and employees. Suppliers appreciate businesses that pay on time because they become reliable long-term customers. Some suppliers even provide better pricing, larger credit limits, or priority inventory to companies with a strong payment history. Employees also benefit because payroll is never delayed due to slow customer payments. Instead of constantly worrying about the next cash shortage, the owner can focus on improving operations, increasing sales, and serving customers. This creates a healthier business environment where financial decisions are proactive rather than reactive. Another practical benefit is that invoice factoring makes cash flow more predictable. Imagine the company issues approximately the same amount of invoices every month. Instead of waiting 30, 45, or 60 days for random customer payments, the owner knows that most of the invoice value will arrive within a few business days after each sale. Predictable cash flow makes budgeting much easier because inventory purchases, payroll, marketing campaigns, equipment maintenance, and expansion plans can all be scheduled with greater confidence. This is why many growing businesses choose invoice factoring even when they are profitable. Profitability does not automatically mean healthy cash flow. A company can report excellent sales while still struggling to pay everyday expenses if too much money is locked inside unpaid invoices. Invoice factoring solves that timing problem by converting accounts receivable into immediate working capital. Instead of waiting for cash to arrive in the future, business owners gain the flexibility to invest in growth today, keep operations running smoothly, and take advantage of opportunities that would otherwise be missed because of temporary cash shortages. Factoring costs, risks, and mistakes. Although invoice factoring can be an excellent cash flow solution, it is not free money. Every business owner should understand the costs, risks, and common mistakes before using it. The biggest cost is the factoring fee. For example, suppose you factor an invoice worth $100,000 and the factoring company charges a fee of 3%. After your customer pays the invoice, the factor keeps $3,000 as its fee, and you receive the remaining balance after deducting the advance that was already paid to you. While this cost may seem high at first, the real question is whether having immediate cash helps you earn or save more than the fee itself. If early cash allows you to accept larger orders, avoid late payment penalties, or secure supplier discounts, the overall financial benefit can easily outweigh the factoring cost. However, there are risks if you choose the wrong factoring company or fail to read the agreement carefully. Some companies advertise very low fees but add extra charges for account setup, invoice processing, wire transfers, minimum monthly volumes, or early termination. Others may require you to factor a certain number of invoices every month, even when you do not need additional cash. That is why understanding the complete pricing structure is more important than looking at the advertised percentage alone. One of the biggest mistakes business owners make is factoring invoices from customers with poor payment histories. A factoring company prefers invoices from reliable businesses because the customer is ultimately responsible for paying the invoice. If your customers frequently dispute invoices or pay very late, factoring may become more expensive or even unavailable. Another common mistake is using invoice factoring to cover losses caused by an unprofitable business. Factoring improves cash flow, but it cannot fix poor pricing, excessive expenses, weak sales, or an unsustainable business model. It should be used to solve a timing problem, not a profitability problem. When used for the right reasons and with a trusted factoring partner, invoice factoring becomes a practical financial tool rather than an expensive emergency solution. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.